Okay, let's try to unpack this. It is February 5th, 2026, and I have to be honest with you. If you've glanced at a market ticker today, you probably feel like you've walked into a room where everyone is shouting in a different language.
It is definitely a noisy morning. Yeah.
Noisy is putting it politely. It feels like all the signals are completely crossed. We have stocks climbing, even though everyone is freaking out about this massive AI security hole.
Right.
Then you have gold and silver, which are supposed to be the safety nets when things get weird, taking a historic nosedive.
A huge drop.
And depending on which page of the news you're reading, the energy sector is either booming or dying or merging into some kind of super entity. It's a lot.
It's a chaotic moment, to be sure. But that is exactly why we're doing this deep dive.
Right.
When the noise gets this loud, the signal is usually hiding in the structural changes. We aren't just looking at stock prices today. We're digging through a stack of intelligence dispatches that map out where capital is actually flowing.
And where it's fleeing. Because frankly, I'm looking at this stack of stories, from Elon Musk's latest shakeup to protests at Target, and I'm really struggling to see the through line. It just feels like a bunch of random events.
It does. It looks scattered, but I promise you there is a map here. We're going to connect the dots between three massive buckets, the reshuffling of the tech giants, the paradox playing out in energy, and then finally the collision between government policy and your wallet.
And we have to talk about the government literally shutting off the data lights, that's concerning.
Oh, we will get to that. It's a major, major blind spot.
All right, let's start with the digital world, because the headline that just grabbed me immediately is this whole Elon Musk situation. It feels like bad science fiction.
Yeah.
Musk is combining SpaceX with his AI startup, XAI, rockets and chatbots under one roof. Is this actually a business strategy, or is he just, bored?
It sounds like sci-fi, but if you look at the financials, it's actually pure leverage. Musk announced this combination right ahead of a potential IPO.
So it's a consolidation play, just getting the house in order for Wall Street.
Think about it. You take SpaceX, which has proven success, massive government contracts, Starlink, and you combine it with XAI, which has immense hype, but is just burning cash to build models.
Right.
By merging them, you create a total juggernaut for the public markets.
But hold on, does that actually make sense, operationally? I mean, what does a Falcon 9 rocket need with a chatbot? It feels a bit like financial engineering, to pump a valuation before asking the public for money.
Oh, there is definitely an element of financial engineering, absolutely. But there is also a structural argument to be made. Think about Starlink.
Okay.
It's a global satellite network. If you want to run AI on the edge or manage a massive autonomous logistics network, having the connectivity of SpaceX married to the compute of XAI, it is incredible.
So he's building a global brain with its own nervous system.
Essentially. And you have to remember, the breadcrumbs were already there. Tesla had previously disclosed, a roughly $2 billion investment in XAI?
Right, I remember that.
And public filings showed SpaceX was already the managing member of XAI Holdings. So they were already dating. Now they're just getting married to present a united front.
Okay, so Musk is going full empire. But then you look over at NVIDIA and you see the complete opposite energy. Jensen Huang, the guy who usually sells the shovel in the gold rush, seems to be walking back the hype.
Softening is the word analysts are using, yeah.
Yeah.
NVIDIA shares actually slipped a bit because Jensen Huang had to clarify a rumor about an up to $100 billion investment in OpenAI.
Which, just to be clear, would be an insane amount of money. That's the GDP of a small country.
Exactly. And Huang came out and basically said that was never a commitment. He reiterated they plan to participate, sure, but he really cooled the jets on that specific number, and the market reacted, immediately.
Why does that matter so much? Is it just a negotiation tactic or something more?
I think it signals that the blank check era of AI investment might be over. Investors are getting sensitive. If NVIDIA isn't willing to throw $100 billion at the biggest AI player without blinking, maybe the returns aren't so guaranteed after all.
But then you look at Palantir, and they are just absolutely crushing it, so someone is buying AI.
Palantir is the vital counterpoint here, because while the consumer-facing AI stuff is getting scrutinized, Palantir just posted Q4 sales of $1.41 billion.
Which is up 70% year over year.
70%.
That kind of growth for a company that size is just huge. Who is buying it?
The Pentagon. The driver here is specifically U.S. defense demand. They issued very, very strong guidance for 2026. This tells us that while the hype around writing emails with ChatGPT might be fluctuating.
Right.
The application of AI in warfare and government surveillance is expanding rapidly.
So the government is the buyer of last resort.
Or maybe the buyer of first necessity.
But here's my worry with all this. We're rushing to put AI into defense systems, into rockets with Musk, into everything. Are we actually securing it? Because this report from Wiz about Moltbook, that actually scared me.
It should scare you. This is the dark side of the boom. As companies rush to integrate AI, they're leaving the digital doors wide open. Wiz found a misconfigured database that exposed 1.5 million API tokens and 35,000 emails.
Okay, for anyone listening who isn't a coder, API token sounds kind of boring. What does that actually mean?
Think of an API token as, like the master key to your house. Actually, wait, it's worse. It's the key to the house, the code of the safe, and the permission slip to hire a moving crew. Wiz found that this breach gave them full read-write access.
Write access.
Yeah.
So they could change things, not just see them.
Exactly. That means anyone who found it could not only steal data, but potentially inject malicious code. Imagine someone altering the training data of an AI model or changing the instructions it sends to other software.
So you could literally poison the brain.
Precisely.
Yeah.
Now, it was patched hours after disclosure, but it highlights this massive systemic vulnerability. We're building these super intelligent systems, but we're securing them with the digital equivalent of a sticky note under the doormat.
Wow. That's a sobering thought. It feels like we're building a Ferrari engine and then mounting it on a go-kart.
That is a very fair analogy.
Okay, let's pivot a little. It's interesting you mentioned locking things down, because while the digital world feels so leaky and fragile, the physical world energy specifically is seeing some serious concrete being poured. I feel like for the last year, all we've heard about offshore wind is canceled, delayed, too expensive. But this week, it feels like the wind is blowing again.
The legal tides have definitely turned. A federal judge just issued a fifth injunction that allows construction to resume on Sunrise Wind. And this follows wins for Empire Wind, Revolution Wind, Vineyard Wind. I mean, the list goes on.
So why the sudden shift? Did the economics change or just the judges?
It's mostly the courts clearing the bottleneck. The obstruction was largely these legal challenges from local groups and some environmental pushback. The courts are now signaling that the projects have met the requirements. So developers like Ørsted and Dominion Energy said they're restarting work immediately.
So hard hats are actually back on site. This is real.
Yes, and that's really significant because it shows resilience. Despite higher interest rates and all the supply chain issues, these projects are pushing through.
But here's the paradox. At the exact same time we're greenlighting wind, the old school energy sector is doubling down. We have this massive merger between Devon Energy and Coterra.
This is the energy paradox of 2026. We were literally doing everything at once. This Devon-Coterra merger, it's an all-stock deal creating a $58 billion shale producer.
$58 billion. I thought oil was supposed to be a dying industry. Why merge now?
Because in a dying, or let's say a maturing industry, scale is the only way you can survive. Look at where they're focused, the Delaware Basin. Their stated goal is $1 billion in annual synergies by 2027.
And synergies is usually corporate speak for firing people and sharing equipment, right?
It's about efficiency. While wind is fighting for permission to exist, shale is fighting for scale. They're consolidating to pump oil cheaper and faster. They know the transition is coming, so they want to be the last giant standing who can still produce profitable barrels.
And speaking of barrels, the price of oil dropped about 5% this week. I saw Chevron even got downgraded because of it. What's driving that?
Geopolitics again. President Trump signaled there were negotiations happening with Iran. The market had priced in this fear of a supply shock, that war might cut off the oil. When those negotiations were signaled, that fear premium it evaporated and the price dropped.
It's wild how sensitive a barrel of oil is to just a few words from the White House. But speaking of the White House, they aren't just talking, they're buying. Tell me about Project Vault.
This is where the tech story and the energy story really collide. The White House unveiled Project Vault. It's designed to pair private capital with EQSM bank loans, specifically to stockpile strategic minerals.
So the government is basically hoarding the stuff we need to build batteries and chips. Lithium, cobalt.
Precisely. We talked about Palantir and Musk earlier. You can't build those AI systems or those rockets without lithium, cobalt, and rare earths. The government is actively trying to secure that supply chain.
And the market liked that.
Oh, yeah. Shares of miners like MP Materials and Critical Metals rose on the news. It's a recognition that in 2026, national security isn't just about software, it's about dirt. Very specific kinds of dirt.
Okay, let's move to the markets because this is where things get really confusing for the average person. Gold and silver. These are the assets you hold when you're scared, right? The world feels scary, yet gold took a historic plunge. What on earth happened?
If you're a retail investor holding gold, this week it was painful. But you have to understand the mechanism here. This wasn't because the world suddenly decided gold is worthless. It was a liquidity squeeze.
Explain that, because to me, a crash means everybody's selling.
Think of it like buying a house. You put a down payment on it. In the futures market, that's called margin. The CME Group, the exchange where these things trade, suddenly hiked the margin requirements. They raised gold to 8% and silver to 15%.
So it's like the bank calls you and says, hey, that house you bought, I need another $50,000 cash in your account by 5 p.m.
Exactly. And if you don't have the cash, the bank sells your house immediately to get their money back. That's what happened to traders. They were forced to sell their gold contracts to cover the new margin requirements. It just triggered a cascade of forced selling.
So it's a technical crash, not a fundamental one.
That's the institutional view, yeah. Deutsche Bank came out and said they are still constructive over the next 12 months. They see central banks buying and all the geopolitical risk as long-term supports. But in the short term, the margin clerk cleared the room.
Got it. So don't panic and sell your jewelry just yet. Now, let's look at the consumer. Who is actually spending money right now? Because the signals are so mixed here, too.
We can actually build a profile of the 2026 consumer based on earnings this week. And honestly, they look a little bit stressed.
How so?
And we'll look at SoFi. They hit a record quarter, their first $1 billion revenue quarter. But where's the growth coming from? Student loans, home loans, personal loans. The consumer is leveraging up. They are borrowing money to maintain their lifestyle.
And where are they spending that borrowed money?
Not at luxury outlets. They're at Dollar General. Value retail is winning. Dollar General is opening stores. They're projecting growth. And you can compare that to GameStop or Walgreens, which are still closing locations.
So we're borrowing money just to shop at the dollar store. That's bleak.
It's defensive. But then you look at Disney.
The House of Mouse.
Disney beat earnings expectations. Streaming is doing great. Cruises are booking up. People want escapism. If things are tough, you subscribe to Disney Plus or you save up for that one big cruise.
But didn't they warn about the parks? I thought I saw that.
They did. That's the other side of it. They warned about softer international visitation to the U.S. parks.
Meaning fewer tourists are coming to America to see Mickey.
Exactly. It could be the strong dollar making it too expensive, or it could be the geopolitical tension we were just talking about. But it's a flag. The domestic consumer is borrowing and bargain hunting, and the international consumer is staying home.
However, there is one macro indicator you flagged that is actually positive. We are making stuff again.
Yes. Amidst all of this, the ISM manufacturing PMI jumped to 52.6 in January.
And for those who don't track PMIs, anything over 50 means the factory lights are on, right? It's growing.
Correct. It means expansion. And this is the first expansion we've seen in a year. You can see it in stocks like Caterpillar, which is benefiting. So while the consumer is hunting for bargains, the industrial base, the people building the machines and the infrastructure, is starting to hum again.
That brings us to our final section, and this is where the rubber really meets the road. The intersection of politics, policy, and corporate headaches. We talked about Target earlier. What exactly happened there?
This is a prime example of how these social issues are hitting the C-suite directly. Michael Fidelk started his first day as CEO of Target, and he wasn't greeted by a cake. He was greeted by protests at the headquarters.
Not exactly the welcome party you're hoping for.
No. The demonstrators were urging Target to take a stronger stance on ICE operations, immigration, and customs enforcement. It just shows that activists are now targeting corporations to pressure the government.
But does that actually work? I mean, do companies really care enough to change?
Well, look at Capgemini. They took pretty drastic action this week. Following all this international backlash over an ICE contract, they didn't just issue a statement. They decided to immediately divest their entire U.S. government unit.
Wait, they cut it loose. They fired the government as a client.
Basically, they decided the reputational risk of being associated with controversial enforcement tactics just outweighed the revenue. That is a massive signal. Companies are being forced to choose between government contracts and public reputation. You can't play both sides as easily anymore.
Speaking of government battles, we have some serious friction in Washington over the money supply. President Trump nominated Kevin Warsh to chair the Federal Reserve.
And this is the story that's going to define the next few years. NPR reports that this nomination has sparked some really serious questions about central bank independence.
Why does that matter so much to the average listener? I mean, the Fed is just a boring bank, right?
The Fed is the referee of the economy. It sets the price of money interest rates to control inflation. It is designed to be apolitical, to operate independently of the White House so that a president can't just, print money to boost the economy before an election.
And the fear is that Warsh is too close to the administration.
Exactly. If the market starts to believe the Fed is just an arm of the White House, trust in the dollar erodes. That complicates Senate confirmation, and it introduces this massive variable of institutional risk that investors absolutely hate.
And while they fight over who runs the Fed, we have an even more immediate problem. The data machinery is just grinding to a halt. The Bureau of Labor Statistics, the BLS, is postponing the January jobs report.
Because of the government funding shutdown.
I just want to pause on this for a second. We are in a volatile economy. We just talked about weird market signals, gold crashing, AI bubbles, and right now the government is saying, sorry, we can't tell you how many people have jobs.
We are flying blind. The jobs report is one of the most critical inputs for investors, for the Fed, for everybody. Without it, we don't know if the economy is overheating or crashing. We're navigating a storm, and someone just turned off the radar.
That is incredibly unsettling. Is there any good news from the government side at all?
A small bright spot. There's a new trade agreement with India that cuts tariffs on certain goods. This immediately lifted stocks like Infosys and, interestingly, Williams-Sonoma.
Williams-Sonoma, the kitchen store.
Yeah, they rely heavily on textiles and goods from India, so lower tariffs mean better margins for them. It's a good reminder that trade policy isn't abstract. It directly hits the bottom line of the retailer down the street.
So let's try to synthesize all of this. We've got fintech and defense AI making record revenues. We have wind turbines starting back up and shale companies merging into giants to chase efficiency.
Right.
But at the same time, the government is shutting down data releases, gold is crashing on technicalities, and companies are dumping government units to save face.
It is a world of volatility, but with a very clear undercurrent. The fluff is getting shaken out. Money is moving into things that are tangible and strategic. Defense AI, energy infrastructure, domestic manufacturing, and stockpiled minerals.
And the consumer is just trying to hang on for dear life.
The consumer is leveraging up to survive while the industrial base rebuilds. The digital world, the crypto weakness, the AI security holes is feeling fragile. The physical world, shale, wind, Project Volt, is getting fortified.
It really does feel like a return to reality, even if that reality is messy and expensive.
Exactly. The era of easy money and move fast and break things is being replaced by secure the supply chain and watch your margins.
So here's a thought to leave you with, and this one has been sticking with me since we started talking. We have the government actively stockpiling physical minerals with Project Vault, preparing for a future where hard assets are king. Yet at the exact same moment, that same government has shut down the release of essential economic data like the jobs report.
It raises a pretty provocative question. Are we entering an era where owning the physical assets matters more than having transparent information?
When the data goes dark, he who holds the gold, or I guess the lithium, makes the rules.
And he who holds the algorithm controls the defense.
Something to chew on while you check your portfolio, if you can even see the data. Thanks for listening to this deep dive.
Stay curious and watch the margins.
We'll catch you next time.